All right, let's talk about one of the classic challenges in business, funding growth. You need capital to expand, but you really don't want to give up control of the company you've built. Today, we're going to dive into a fascinating case study that solves this exact problem. And it does it by using a powerful and frankly surprisingly tax-efficient tool, the limited partnership. Let's get right into it.
So this is the fundamental question, right? It's the central dilemma that was facing our case study subject, a company called Diamond Ltd. Here you have a profitable business. They've got ambitious plans for growth, but they just don't have the capital on hand to make it happen, at least not on their own terms.
So first things first, let's break down the numbers. You really need to see the specifics to understand the scale of the challenge that Diamond Ltd was up against.
Okay, look at this. Each new restaurant location requires a huge upfront investment, $1 million just to get the doors open. And the projections, well, they show it's not going to be easy. We're looking at significant losses in the first 2 years before it finally turns a projected profit of $100,000 by year 5. That initial cash burn is a massive, massive hurdle.
Now let's get into the nitty-gritty of the cash needed. Even after they get a mortgage on the property, the total capital they need to raise for each new location is a staggering $600,000. And you can see where it goes. Equity, working capital, those heavy opening costs, and enough cash to just survive those early losses. This is so much more than the $50,000 that Diamond Ltd can actually contribute per location.
So what do you do? Well, the company went out and approached large, wealthy investors. But, they ran into a classic problem. In exchange for their money, these investors wanted a huge chunk of ownership and, this is the critical part, a major say in operating decisions. For the owner of Diamond Ltd, giving up that kind of control was an absolute deal breaker.
With that traditional route totally blocked, they had to get creative. The solution they came up with started with one key decision, and it was all about tackling that massive initial cash requirement. Instead of buying the land and the building, they decided to lease it. It sounds simple, but it was a brilliant move. Just by removing that $200,000 equity payment for the property, they immediately cut their capital needs by a third. They went from needing $600,000 to a much more manageable $400,000.
And right here, this is the core of their solution. They decided to form a limited partnership. Diamond Ltd would act as the general partner. That's the one running the show. And they'd contribute their $50,000. The other 87% of the cash would come from 35 smaller, limited partners. These are passive investors who provide the capital, but have absolutely no say in the day-to-day operations. This chart really shows the genius of this setup. Look closely. Diamond Ltd creates a subsidiary, which becomes the general partner. This entity retains all management control. Meanwhile, the capital, the $350,000, it just flows in from these 35 limited partners over here. See? There are no lines giving them any decision-making power. This complete separation of capital from control, that's the key to the whole thing.
Okay, so let's drill down into the specific benefits of this structure for the project initiator, for Diamond Ltd. How exactly does this solve their core problem of growth without giving up the driver's seat? So let's just look at the payoff for Diamond Ltd. It's fantastic. They get to achieve all their expansion goals, and they keep what matters most, 100% management control. They only put in 13% of the capital, yet they get a 30% share of all future profits. And by using that subsidiary structure, their total financial risk is capped at just their initial $50,000 investment. It's a beautiful thing. And this number right here shows the incredible financial leverage they achieved. Once the restaurant is profitable, their $30,000 share of the profits represents a staggering 60% pre-tax return on their initial $50,000. I mean, think about that. For just putting the project together while keeping full control, that is an incredible outcome.
But of course, a deal like this only works if it's also a good deal for the investors. So now, we've got to look at the other side of the equation. What makes this an attractive proposition for those 35 outside investors who are putting up 87% of the cash?
The answer, and this is probably the most elegant part of the whole structure, is taxes. Specifically, it's how the partnership treats those early business losses. You see, in a corporation, losses are just stuck inside the company. But in a partnership, those losses flow through directly to the investors. You can think of it like getting a tax coupon that they can use on their personal tax return to lower the tax they owe on their other income.
And those losses are huge. This slide shows a total tax loss of $350,000 in just the first 2 years. Now you might be asking, why is it so big? Well, it's because tax rules allow businesses to immediately deduct many of those one-time opening costs.
So that $200,000 they spent on training and supplies in year one gets added to the $100,000 operating loss, creating this massive, single-year deduction for the investors.
This table shows exactly how this works for an individual investor. It's brilliant. They put in $10,000 cash. But because they get to deduct their share of the partnership's losses, they save $3,500 on their personal taxes. You can see that calculation right there. What does this mean? It means their actual out-of-pocket cost is only $6,500. The government, in effect, is subsidizing more than a third of their investment.
That tax break completely changes the math on their return. Their expected $2,000 annual profit delivers a massive 31% pre-tax return. And why is it so high? Because they're earning it not on the full $10,000 they wrote the check for, but on their actual cash out of pocket of just $6,500.
And even after they pay their own income taxes on those future profits, the final take-home return is a very, very healthy 15.5% on the cash they actually invested. For completely passive investment with limited risk, that's the kind of number that gets deals done, plain and simple.
So, to really drive home just how powerful this partnership structure is, let's do a direct comparison. Let's look at what would have happened if they'd used a standard corporation instead.
This comparison makes it crystal clear. With a partnership, investors get to use those losses immediately. With a corporation, those losses are trapped inside the company. A partnership has a single layer of tax, a corporation has that dreaded potential for double taxation. Even the downside risk is lower, a maximum after-tax loss of $5,000 in the partnership versus $7,500 in the corporation. The partnership is superior for the passive investor on every single key metric.
So, to wrap it all up, this structure creates a true win-win scenario. It spreads the risk, it reduces the real cash cost for investors through those tax savings, and it offers them a really high after-tax return. And for the business owner, it allows them to raise the capital they desperately need while giving up minimal equity and, most importantly, retaining absolute management control.
So the crucial point, and really the main takeaway from this whole analysis is this. While a limited partnership can be more complex to set up, its ability to improve after-tax cash flow for everyone involved is just profound. It is a structure that absolutely has to be on the table for any business that's looking for expansion capital from passive investors.
This case study is really a masterclass in financial engineering, but it leaves us with one final and I think crucial question. When a general partner holds all the control, they also hold all the responsibility. So beyond the financials, what operational and ethical duties do they have to the dozens of passive investors who have trusted them with their capital? That's something to think about.